I'm sure you've seen a candlestick cheat sheet like this before, but have you ever seen one like this? Many videos on YouTube talk about candlesticks, but no video on YouTube truly teaches you to understand them. Learning to understand what each candlestick is telling you on a smaller time frame will unlock your ability to read the market. Without this, you are just blindly copying patterns, and you are definitely not going to become a profitable trader trying to do that. And so what we want to do is really learn to understand what the candlesticks are telling us. This dragonfly doji right here opened up here, broke up a little higher, sold off really hard, and then reversed, closing a little bit lower. And so this shows you that there is a strong potential for a reversal in the process. And so what you can do with this is you can start to combine it into multiple candlestick patterns, where for this 3-line strike pattern, what we can see when we dive into the candlesticks here is that there is, based on these 3 bullish candlesticks, there is most likely on a smaller time frame, a upwards channel that then all of a sudden, based on this candlestick, gets broken rapidly. And so to show you what I mean by diving deeper into a smaller time frame and the candlesticks, let's say these candlesticks are from a 10-minute chart. So each one of these candlesticks are 10 minutes worth of price data. And so if we went into a smaller time frame chart, I don't know exactly, let's say this is probably like a 3-minute chart. I didn't perfectly, size it out, but this is kind of illustrating what I mean is the price movement when you dive deeper will look more like this, as it's methodically moving higher in a consistent upwards channel. And then all of a sudden you have these massive, big, bearish candlesticks that just punch the price lower. And so that is how, if then you zoom back out to your larger time frame, you would see this candlestick pattern. And the significance behind this candlestick pattern and why it's so powerful is because if you just think about, well, the basics of it breaking this uptrend, well, that's a reversal pattern in itself. Usually you have, when you have a trend line drawn and the price breaks that, well, that's a reversal pattern. But if you look at this as well, is a couple key factors to think about with it is how much price movement this one candlestick gave back up. It reversed all 3 of these candlesticks before it, and it did it over one candlestick. And so it's showing you a massive switch in momentum going forwards that you can use this for a really good signal to get in on a potential reversal. And so to quickly show you a real example using this, look at what we have right here. We have a nice methodical move higher, and you can see that the candlesticks are starting to slow down. And then there's a massive bearish candlestick here for a engulfing candlestick that just, the price opens here, closes here. It gives back the move of all these candlesticks. It breaks massively below them. And then that is what I use to enter in on a reversal signal. This for me is kind of my final signal for trades when I jump in, is using 3-line strike patterns just like this one. And you can see they don't always show up perfectly, just like in, kind of how cheats show. That's why it's important to start to read into these even more. Just to show you another example is, here's another spot where the market has made kind of a methodical move higher, where you can see it's kind of making good stair-step patterns. There's probably on a smaller time frame a nice little tight channel right here, and then all of a sudden you can see that it starts to make a couple of dojis here. There's a bearish candlestick here. You can see it starting to slow a little bit in momentum, and then this next candlestick, if I just zoom forwards a little bit here, is it starts to drastically jump lower, making that engulfing candlestick or that big bearish candlestick that is involved with the 3-line strike pattern. And you can see that from this one, it gives back all of the moves and breaks below all of these candlesticks before it, really starting to show that pattern. And so for me, what I like to do when using these for entering in trades, I like to enter in when it breaks below that low. And I think another thing that is a really great confirmation of these trades that I like to see is, if you look right now, it's the candlestick after it, reading into what it's showing you, we can see this in real time, is it opened here, it pushed higher, and then it's my idea is, okay, if it breaks down here, this is my entry order for a trade, I want to jump in. And the idea behind that is you have this big bearish candlestick before, and if the market decides to, sell off there, come up and, start to recover and retrace, which is what this green candlestick is doing. Well, if it decides to then reject that attempt to, recover and keep going higher, then I think that's a good signal for it to keep going lower. And so this green candlestick right here finishes forming, and I'm still waiting. Okay, well, maybe it holds that, or maybe it just breaks lower and does the kind of failed attempt to continue higher that I want to see. And so from there, the market fills me and I take a trade to the short side, but that's all based off of this 3-line strike pattern that I saw here. And so now I want to go through this cheat sheet that I've made and kind of dive into how to read a bunch of these candlestick patterns and show you kind of what I mean and how you can start to really unlock the potential of reading candlestick patterns. And I'll actually show you how to properly use these. What you do, you don't want to just blindly use these by themselves. You need a couple of things to add on to really enter in based on a trade, like some of the ones I just showed you. But also another way to use these in reverse when they fail, to actually take a counter reversal trade. And I'll show you an example of that. And as well, this cheat sheet, I will link in the description below. You can get it for free. And so first off, with this basic candlestick pattern right here, this hammer candlestick, this one's a pretty simple one. There's nothing crazy to it. It's actually using that dragonfly doji we just talked about, and all it's doing is it's showing you that there is a consistent downtrend followed by a dragonfly doji or hammer candlestick pattern at the bottom, and then the market just continues higher. And so this is really just a V bottom, V reversal, and to be quite honest, these aren't ones that I find very tradable. You can see these everywhere in the market, and most of the time, most of the people I see are FOMOing over these. These are not worth your time. It's not worth the risk of trying to catch what people can call a falling knife, because sometimes there's no confirmation with this V reversal. It just happens and you just gotta watch it go. But a different one is this hanging man pattern right here. This is way stronger of a pattern, and the reason why is because this candlestick is now flipped. If you look at it compared to this one before, this one is showing that, okay, it kept going down in reverse, but instead this one over here is showing you that the market moved up, that made a double top here, and then it starts to reverse. That's what this is showing you, is it's showing you the price peaked, tried to sell off, and then made one more attempt to go higher, kind of like what I was just talking about in that trade entry I just showed, and then it failed. And essentially, it made a double top here, and that is way more of a reversal confirmation. And so this is a really good pattern to actually use. And quite often when I see a pattern like this, where I actually want to enter in is a break below either this candlestick here, or if the candlestick after it forms like this, just order at the break below this one, because really you're breaking below the last 3 candlesticks, or even these 2 right here. That is a really, really good signal to jump in. You can just push your order there, stop up here, and then bet for a market move lower. And then a different kind of reversal here, this is reversals on both sides, is a bearish and a bullish engulfing candlestick. And so this a lot of times is a 2-pattern candlestick. It's just these 2 taken together. And the whole psychology behind this is that there is a gap in the price. And so what that does is, if we just look at this bullish one right here, is you can see the candlesticks are moving lower, moving lower, moving lower. It closes here, and then all of a sudden the next candlestick opens up down here. And so there is this gap right here in the price where it didn't continuously move. There was a jump in the price between the 2 candlesticks. And so then once that jump happens, this candlestick shows you that, well, it sold off a little bit, but then it punched higher, closing way above this candlestick. And so there is a gap created based on that. and a strong bearish sentiment of it engulfing the previous candlestick. And then from there, I often jump in. I like to jump in above the break of this candlestick, and you can often see it start to move higher based on that. And so for this one, it's just the flip side, right? It's just the same thing. Market moves up slowly, closes here, then there's that gap, and then a big rejection. And so that's what you want to see, is there's that gap, because all of a sudden a ton of people, these don't really happen on a smaller time frame like a 1 minute chart because the price is moving so quickly, but this can often happen on something like a daily chart where the day closes out here, there's some news or just momentum from the previous day. And so it'll open here, and then all of a sudden there'll just be this massive rejection that next day. And then from there, that's a good day to either jump in short at the end of the day when it's kind of closing down here, or the next day you can see how things open up and then jump in based on that and then look for a reversal lower. And of course, all these I think are really important to have with a couple of factors that we're going to talk about in a minute. And so here, this is a different type of gap. And so what you can also have is a gap on both sides that create what is called an island. And so what this looks like is, again, this can normally happen on a higher time frame, but you can see it on smaller time frames. And so generally it's just the price is moving lower. It closes here and then jumps, makes that gap. And the important part about this one here is that there's this doji here. That's consolidation is happening. Once that jump happens, is the market's kind of like, okay, I don't know what's going on, what's happening, and it kind of just sits there for a day or however long that candlestick is. But then the next candlestick makes a gap in the other direction, generally filling this amount. Generally, when the market makes a gap, it likes to fill that. You see this everywhere. And it doesn't have to be necessarily a straight up gap like this. Even when there's just a massive move where the market moves down really quickly, it'll oftentimes, when it reverses, it'll give that move back up very quickly as well. I often use that for targets. And so, but in this case, fills that gap, makes a bullish bar, and then from there you can look for a reversal higher. And so this isn't something I usually trade because I trade on smaller time frames, but it's very important to be looking out for this. And again, you see this on the flip side, again, where it's just completely reversed, and this is a good reversal to the downside pattern. And so if you ever see that, be aware that the market might be looking to reverse. And so these are very, very similar. The evening star and the morning star, I just call these a strong island because the idea is that we still have that same move down, closes here, and then it jumps all the way down here because again, this is a bullish bar, so it opened here, and then it closed here and gapped back up. And so it almost filled the whole gap up in that day. And so I think that's even stronger of a signal than the doji star ones over here, because it's showing you the momentum is already flipping. It's very similar, actually, if you think about it, to this bearish engulfing and bullish engulfing. These are technically just islands and gaps that filled the next day. And then these are just slower ones that took more time. And so that's the thing, how you want to really have a well-rounded understanding of how the market works and how these can play out, because this is one pattern and you can see it in 3 different ways. And so, and they show you the same thing, in this case, it jumps all the way here, almost gives that back up, but then it closes, and the next day it does its major move. And so that's really important to understand, and why reading into these moves is, I think, really important. And so moving on, another one, and I think this is very similar to a exhaustive move concept that we're going to talk about in a second, but what we have here is very similar to, I would say, the 3-line strike pattern that we were pretty much just talking about, where the market just is in a nice consolidated move, and then all of a sudden you just have a big bullish move higher. Same thing here, just a nice consolidated move. The market, it's just moving higher, chugging higher. And based on this gap though, that's the key here, is that there is a gap here in this price. And that shows you that an overnight, generally, because most of the time gaps happen on a daily chart, is that it got too excited overnight, is that people were seeing this trend higher and they were saying, wow, I gotta get in on this. Look, it's been going all day, for the last week, it's been going really, really good. It's people chasing the trend. And so that's how gaps are created a lot of the time. And then from there is the next day opens and it just starts to cruise lower, and it engulfs that previous candlestick, and maybe it engulfs the day before as well. And so those are really good reversal patterns. And as well is the last kind of island that we have is just the same thing as kind of that doji, but again, it's just expanded out. That's why it's always important to realize that these patterns don't have to happen exactly the same every time. If it has 2 candlesticks or 3 or 4 like this, it could still just be sitting there consolidating and waiting, and then boom, it has that gap down and then reverses. And so that's why you want to be, when you're trading, open-minded and be aware that things can still play out, but they might show up slightly different every time. That's why trading can be so hard, is because it never shows up exactly the same. Now, this is an interesting one. This is something I see a lot in the market. And I think a good way to describe it is really kind of like a bullish consolidation, or it's bullish and consolidating for a reversal to the upside. And this can be flipped, we'll see in a second. But generally how I see, the market's reverse in a couple ways. You have that first thing we saw, that first pattern we looked at, which is just the V bottom, where the market just cruises down and just cruises back up. Those are really, really hard to catch. You have, your double bottoms, you have your engulfings here that are a little harder to catch sometimes too. But then as well, a lot of the times, and these are really nice because once you see them, you can really start to see them coming, is the market just is in a slow, methodical move lower. It's trending lower, and then all of a sudden, a trend has to come to an end at some point, and not all the time is it just gonna reverse higher. But a lot of the time is it'll just kind of slowly start to dwindle, and it'll start to slowly just move higher. And that's what's happening here, is these candlesticks are just, you can clearly see is if, we had more candlesticks that are just coming down here, is, the trend's over. These are not big bearish candlesticks anymore, right? And so it's cruising slowly up, which is just clearly different. And so the big question here is, okay, is this gonna break higher or break lower? Because this can be a continuation pattern as well if you started to get big bearish candlesticks here. And so once it breaks kind of here though, or starts to get more of a momentum candlestick in play, that's when I think it's better to jump in kind of at, a break of this candlestick or a close of this candlestick, and then look for the market to move higher from that. And you have this, of course, in the flip side, which is all the way on the other side of the sheet for some reason. And for me, a lot of the time these work, the bearish side works way better on these, because I don't know why, but for me, I see a big trend going up, and then it just looks like it's just looking like it's gonna fail and give that back up. And this is where that gap, I think, comes into play on a smaller time frame, is where if you see a market just kind of trending higher, and all of a sudden it makes a big move up and then starts to sit there and slowly have this kind of bearish consolidation, it's gonna wanna give this move back up right here. And so a lot of the time you'll see is, it'll maybe make a fake higher here and then a move lower, and you can jump in short right there, or it'll start just to break lower like it does here, and you can jump in short here and capture this move down, and it'll generally bounce down here, and that'll be a super simple, easy target to go off of. And so that's how I like to use these bearish or bullish consolidations. They're really, really helpful for that. Going through the rest of these, there's a couple more important ones. We've seen our V reversal or double bottom. We just looked at a double top in the flip side. Again, this is a really nice one I like to see. If it does this double bottom, I like to jump in kind of either a close of this or a break above the high of this doji or inverted hammer candlestick. Now this one right here, I think, is a really important one. I like to call this an exhaustive move. And so what it's kind of showing you is that the market here, these candlesticks, it's in a nice methodical move up, especially based on these two. And then it starts to, this candlestick right here is a little bigger. And so it starts to kind of get excited here and actually does a little gap here. And so it gaps higher. And so what happens here is essentially the market's moving in a nice consolidated move. And instead of like those 3-line strike patterns where it just craters lower instantly, is instead, and I think this is a better signal because it's easier to see coming and actually trade, because the 3-line strike patterns can just happen so quickly, is instead this one is where the market just goes parabolic essentially, where it kind of gets into, becoming a bubble almost, where it starts to move up so fast that you can't, it's not sustainable, right? And so a lot of the time, well, like a bubble, it has to pop. And so you have it where it moves up in a nice methodical move, and then it just over exhausts itself by doing this exhaustive move, I like to call it, and then it reverses quickly. And so what you can do is, sometimes you can see this on a smaller time frame, and you can jump in when it kind of gives that initial move back up. And a lot of the times is this will make a 3-line strike pattern on a smaller time frame, where this will just crater in quickly. You can jump in here, and then you can capture the rest of the move lower. And so that's a really important one. You can kind of see it in some of these other ones. Here's another good example of these exhaustive moves, and these are showing up slightly different, where in this case, you can see right here is it moves up methodically, and then there's this big candlestick pattern here, and then it just kind of gaps lower and kind of sits here for a second. It's starting to consolidate and say, okay, I've lost steam, what am I gonna do? And it's that weak consolidation for this bearish side, and then here's kind of that bullish consolidation, and then it breaks lower and continues lower. And so these are all usable in a trading strategy, and I like to use these as the final confirmation to really jump into a trade. I don't think you should ever be just blindly looking for one of these patterns and then jumping in. I think it's always best to add them together with other things. So let me show you what I mean by combining this with a few things and understanding the big picture of the market, so then you can use these smaller picture time frames to jump in on a trade. And so right here, as I put in a sell order waiting for it to fill, what I'm looking at is just, look at what the market was doing beforehand. It's kind of been in this back and forth. There's this upwards trending resistance line. And so what it's done is it's come up into this area again. And so just based on the big picture of that, I'm gonna think, okay, well, that gives it a good likelihood that it pushes lower off of that again, right? And so I don't want to just blindly do that. I want to use some confirmation to give myself an edge in the market to do that. And so looking at this, kind of the first thing I'm seeing is, well, okay, we have a big move up, lots of big candlesticks, big bullish candlesticks coming up, and then all of a sudden it sits there. There's like 6, 7 dojis right there where, the price doesn't move at all, and then it breaks lower here. And, the reason why I didn't jump in right here, because this would be kind of that bearish consolidation pattern that we were looking at, where, it just kind of sits there and starts to slowly move lower. Well, I want to wait for it to kind of move lower once, show me some of that, give me basically a confirmation that it might do that, and then punch one more time higher. You can see that happen over here too, actually, is, I'll just zoom forward just so it uncovers that, is where, basically what it did was it punched higher here and then reversed one more time. And so that's what I'm kind of looking for here. And so I like this big candlestick right here. I kind of just jumped in kind of at the low of that candlestick. And then from there, I just looked for it to move lower. And then I slowly trailed my stop loss up. And with this, you don't have to be right all the time. I get generally 2 to 3 times my risk. And so that allows me to not have to be right even 50% of the time. And so in this case, it looks like I got about, it closes up here about $600. And so that's about 1 times my risk reward right there. Not great, but you know what? In this small move of a market, and it definitely had potential to go all the way down here, that is totally okay. And so another thing that I want to talk about is looking at these, what you can do once they start to switch and fail on you, you can start to use them as continuation signals as well. And so think of it like a trap, basically. And so for me, generally, what I like to do is I like to take reversal trades. That's kind of my bread and butter. That's generally what I do. And generally what I look for with that is I look for the market to come down to a big support zone, gives me that context that it's likely going to bounce there. And then I look for, that current downtrend to kind of be broken. And then from there, I look for, kind of those candlestick patterns where this looks like it made a big move lower, kind of that exhaustive move that we were talking about, because you can see it kind of rejected that, filled that gap essentially. And then I'm looking for, right here, I'm looking for it to make kind of one final punch lower, essentially attempt to keep going lower, and then an attempt to keep going higher. And so instead what you can do is, if I just zoom forwards here, because we don't want to wait all day for this to happen, is this, it's happening right here, is where the candlestick, it makes this essentially a higher low right here, and it pushes higher. This candlestick right here pushes higher, and then it starts to immediately make an engulfing candlestick lower. And so I like that in terms of essentially a reversal. Is it looks like it was going to give a signal to the upside. There's almost even like a little head and shoulders here, but my overall thought on the market was, and big picture, and this is what you always want to do. You always want to have the big picture in mind, because again, these micro patterns only happen for a short amount of time. If you're going for a bigger swing and a bigger trade, you need that big picture to come in play. And so then what I did was I said, okay, boom, this is a nice big bearish candlestick. I like that as a signal to get short on, and for it to essentially bait people in. This is a trade that I might have got in before, jumping in here, betting that the market was gonna go higher, and instead it reversed and trapped people. And so it trapped maybe older me, right? Or someone getting new and getting better at reversals. And so instead, when that happened, I said, I actually think that it's going to break this major support because of a few bigger picture factors. And I was able to use that candlestick pattern as a signal to jump in lower. And so I was risking about $500 on this trade. And as it punched lower here, I split my order because I wanted to scale some out. I've started to scale out of my trades a little bit as things start to move really quickly in my favor, because this punches down quick and I'm up $1,500. I'm about 3 times my risk already. If this is where I initially entered in on and my stop was up here, we've come down a long ways already. And so I want to jump out of 2 out of 3 my contracts, scale out essentially 2/3, and my trailing stop I'm due is essentially a previous candlestick high on a 1 minute. And so what I do is, it makes these 2 big candlesticks moves down. It kind of shows it's starting to lose that momentum, and so it knocks my 2 contracts out there. I close out basically that $1,000 in profit, and then I have one more contract here that I give a little bit more wiggle room to. And so I let it kind of break lower, and it comes to kind of a bigger support level where I think that, okay, here's another spot where the market's likely to reverse and find support, and this good downtrend that I'm in is likely to fail. Because if you think about it as well, there's this whole big downtrend here, and I entered in halfway through it. And so you got to realize that, it did break this big support area. So there was that clear big break and momentum once it did that. But now, the trend is going to get a little overextended. It's at an obvious point where it's going to slow down. And so from there, I want to trail up and get out of my last contract. And so as this trade closes out, I highly recommend going in the description below and getting that candlestick cheat sheet. It dives even more into how I read these candlesticks and a little bit more breakdown, some key things to look out for and to avoid as well. And as well, if you want to learn more about how my strategy works and how I combine my 5-step checklist with these candlestick patterns to enter in on trades, check out this video right here. It will go into every detail and step in that process.